Bitcoin's interesting because, like gold, it doesn't have earnings, but like equities, it's still treated like a risk-on asset. And so in some ways, it's a more pure liquidity barometer, or
Sure.
liquidity correlate than any other asset class of similar size. And so that's my general view, is that it's probably going to continue to be pretty heavily correlated with liquidity, with the exception of major headline risks. So the United States buys 500,000 coins. I mean, that's going to override liquidity for a period of time, kind of like how the election was really positive for price for a number of months, even though liquidity was not really great, because when you have a major like administration change and major favorable shift toward Bitcoin, that can override that liquidity correlation for a period of time. So in general, I expect it to continue to be pretty correlated with liquidity as a base case. Bitcoin is potentially one of the ways to express it, and there's other kind of industry-specific variables that you can go to.
The idea that the 4-year halving cycle is a set rule is widely held in the Bitcoin community. According to Alden, this cycle may be changing as Bitcoin develops. The price oscillations of Bitcoin might begin to resemble those of larger macroeconomic cycles rather than the conventional 4-year trend. Lin's favorite measure, market capitalization to realized capitalization, indicates that Bitcoin has not yet attained the exuberant heights of previous bull runs. A market value that is significantly higher than the realized cap traditionally indicates enthusiasm and frequently precedes a sharp drop. This statistic compares the market cap to realized cap and evaluates the previous movement of coins. However, the fact that Bitcoin has only experienced mild excitement thus far in this cycle suggests that more gains may be possible before this cycle peaks. Take a moment to like this video, subscribe to the channel, and turn on notifications for more content on Bitcoin and the digital asset space. Also, drop your thoughts in the comments below. It helps with the YouTube algorithm and supports the channel. Thanks, and enjoy the video.
I think cycles are probably going to look a little different. I think people assume that the 4-year cycle is built into law. I think as Bitcoin integrates more with the system and becomes larger, I think those cycles could change in structure. And it's certainly the case that it could peak for a year or so, but that might be different than peaking for like a 2 to 3 year period. And and this goes back to the other metrics I look at. Like, for example, there are on-chain indicators and other metrics of euphoria that you can kind of measure in the Bitcoin space. And one of my favorites is market cap compared to realized cap. And realized cap is basically just on-chain average cost basis. So like, what is the price of the network, except instead of using the current Bitcoin price for every coin, you look at every coin and price it the last time it moved, which is generally a lot of that volume is when people send it to exchanges or brought it from exchanges, which is a pretty psychologically important price level. And the point of all that rambling is that when you have a big disconnect where market capitalization shot up way faster than cost basis, you're more at risk. It's a sign of euphoria, and the prices that we're seeing might not be, say, quote unquote real, because they haven't really been like liquid and realized for a long enough period of time. And what I would say is that this cycle hasn't reached anywhere near the levels of euphoria based on that metric or similar metrics than the prior major like multi-year cycle tops. But for example, in like say March 2024, it reached like a moderate level, and we did get like a 7-month consolidation. And then it reached kind of similar levels back in say November 2024 when it broke out and kind of touched 100K for the first time. So certainly these like mid-level euphoria periods could give us 6-12 months of consolidation. I would just classify that a little bit different than what we've seen in like major tops. Potentially, yeah, and there's some number crunching on this. So like NIDIG has done really good research on this. Like pre-2020, the correlation between Bitcoin and equities was lower. Then it became higher. Now, a lot of that happened because liquidity became a much bigger factor. So when we're doing like major fiscal and monetary liquidity bazookas, the correlation of a lot of things goes up. And so that's kind of been like an artifact of that. But then certainly, yes, of course, once we get the spot Bitcoin ETFs that we had, and then now we get these other aspects going on, more integration between Bitcoin and the financial system, that can certainly increase correlation. We also, I partnered with Sam Callahan, and we released a research report on the correlation between Bitcoin and liquidity. And we also compared other asset classes to liquidity. And at least the way we measured liquidity, Bitcoin had the highest correlation with liquidity compared to stocks, compared to gold, compared to bonds. And I think there's a couple of reasons for that. One is it's so risk-on assets generally have higher positive correlation with liquidity. So that stocks, for example, whereas gold's more mixed because it's sometimes it's risk on, sometimes it's risk off, but it's got a little bit of a different dynamic there. It's not a pure risk on asset. Bitcoin's interesting because like gold, it doesn't have earnings, but like equities, it's still treated like a risk on asset. And so in some ways, it's a more pure liquidity barometer or liquidity correlate than any other asset class of similar size. And so that's my general view, is that it's probably going to continue to be pretty heavily correlated with liquidity, with the exception of major headline risks. So the United States buys 500,000 coins. I mean, that's going to override liquidity for a period of time, kind of like how the election was really positive for price for a number of months, even though liquidity was not really great, because when you have a major like administration change and major favorable shift toward Bitcoin, that can override that liquidity correlation for a period of time. So in general, I expect it to continue to be pretty correlated with liquidity as a base case. So if someone has a view on liquidity over, say, a 6 or 12-month period, Bitcoin is potentially one of the ways to express it. And there's other kind of industry specific variables that you can go to. Like a lot of my research kind of focuses on that because I'm kind of tied into that space. And so yeah, I think there's be more and more kind of integration in that sense. In addition, it's one of the it's like the most liquid asset on like a weekend, or one of it trades 24/7. So a lot of times people use it as like a weekend sell signal if they want to de-risk their portfolios due to something over the weekend.
Government spending is one important area to monitor. The current GOP platform, for instance, has pledged not to reduce Medicare or Social Security, so any deficit reduction would need to come from other sources. It's unlikely that we'll see much budgetary restraint, though, as big deficits are anticipated over the next 10 years. This implies that liquidity infusions might go on, which could eventually help Bitcoin. Furthermore, some politicians have proposed that the U.S. government buy more Bitcoin. Lynn Alden cautions against basing financial decisions on such headlines, even though this is still hypothetical. Rather, she suggests concentrating on more general macroeconomic patterns and the changing use of Bitcoin as a financial asset. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
I would say that the market is there's a higher level of uncertainty around the thesis than there was, say, maybe 12 months ago. But the reason I don't think it contradicts it is because we can't just take claims at face value, right? So in the prior Trump administration, they said they were going to pay off the national debt, cut healthcare costs, XYZ, and some of their campaign promises happened, like tax cuts, but other ones are kind of very challenging to do. And so these big claims like, hey, we're going to cut $500 billion from the deficit on a year after year basis, we're going to cut $1 trillion from the deficit. Those are rather large claims. And what makes it challenging is when you look at, say, for example, the 2024 official GOP platform, Promise 14, right at kind of the top of the document, was we're not going to cut Social Security or Medicare or raise the retirement age. And so that's like a difference between this current era of Republican politics than say the Paul Ryan era. So let's call it the 2020, the kind of the 2020 era versus 2010s era, is that it's less about cutting these really big cost centers for the government. And one of the ways to get around that is to say, hey, we're going to cut a lot of waste, right? It's, government's full of waste. We're going to cut a lot of waste, and therefore we're going to trim a ton from the deficit without impacting things that really impact American citizens, right? That's kind of the claim you make. It's kind of like saying, hey, we're going to cut taxes, but we're not going to grow the deficits or have an inflation problem from doing this. Or we're going to raise taxes, but we're not going to cause a recession by doing it, right? It's kind of like every kind of political party wants to have their cake and eat it too in terms of their signaling on what they're going to do. They want to advertise the benefits and downplay the potential costs. And so in order to make really meaningful headway in the deficits, and I certainly admit that this has been certainly more shock and awe than we've seen in any kind of prior attempts. So it's certainly, uncertainty is certainly elevated, I grant that. But when we see like, hey, we closed this, $3 million real estate thing. Hey, we got another thing. Hey, we got another $1 billion thing this time. When we're talking about like $2 trillion deficits with like, and we did actually another report on this. I did one with Sam Callahan on the whole fiscal dominance issue. And basically like over 80% of the spending growth expectations over the next 10 years are tied to those more entrenched entitlement programs. And so they take rather significant overhauls to go after. Major overhauls of Medicare, major overhauls of Social Security. The big area, DOD, that's probably one of the biggest variables because, the whole thing, Pentagon's not audited, really big cost center. very politically entrenched. I mean, every single congressperson tries to defend whatever like
Yeah.
DoD spending's happening in their district. So that's like a whole political thing. And again, we have to watch that play out. So I think, once we get, we're 5, 6 weeks into administration, I think we have to watch this play out a little bit longer. But I still like whatever kind of the market-based case is, I generally take a little bit of the under in terms of at the end of the day, raw numbers. So
Right.
not the number of optical wins, but the raw numbers. Like, are we going to have the deficit? My base case is no, but I do think that we are at least fiscally consolidating, which means I don't think the deficit's really going to grow this year. And so I'm certainly for multiple reasons, from deficits to tariffs, more generally on the defensive. My base case is they don't touch gold because why? Like if you have a money printer, why would you touch your gold that you haven't touched in decades? Now there are some reasons to touch it in the sense that if there's like wonky mechanisms where like you can reprice gold and like fill the Treasury General account up with cash, and it's like an offset of asset and liability on the Fed side. So it's kind of this like accounting thing that happens because they still book the gold that they have at like 50-year ago prices, and they can change that. They can technically sell some. So, but even without selling it, just by repricing it, they actually have some interesting buying potential. So we'll see what mechanisms they do. As far as the impact on gold, if you look at like World Gold Council, they estimate over 200,000 tons of above ground refined gold in the world. That's you're looking at 40,000 tons at central bank level, and then of course tons of private investment demand, and then tons of jewelry demand. You generally have something like 3,000 tons hitting the market per year in new production. And so the 8,000 or so tons that the U.S. has, if they sell 2,000 tons or 3,000 tons, which again wouldn't be my base case, but that's certainly market affecting. I mean, you could sell a year's worth of production, but compared to the overall size of the market, I think it's more of like a headline risk than like a disastrous price risk for the asset itself. It's a big and liquid enough asset. That's kind of one of the purposes. Now for Bitcoin, because Bitcoin's roughly the 10th of the size of the estimated gold market, and the if you take out lost coins, and I mean now with the correction, Bitcoin's a little bit lower, so it's a smaller enough asset that United States could have a massive impact on Bitcoin if they say, hey, we want to go out and buy 1 million coins. Now that's not my base case, even though there are some bills like the Cynthia Lummis bill and others that are advocating for pretty large purchases. My general base case is to err more conservative and assume maybe they'll ring fence the Bitcoin they already have and stop selling it and reclassify it. Maybe they'll buy a little bit around the margins. Certainly as a bull on the asset, I'd rather be surprised to the upside than surprised to the downside. So I kind of assume little to nothing and don't really base my Bitcoin price thesis over any kind of multi-quarter or multi-year period on one headline of what the U.S. is going to do, because I'd rather have that headline be positive than negative.
Lynn Alden points out that in the current economic environment, there is more ambiguity surrounding government initiatives than there was a year ago. She notes that big promises, such as reducing the debt by trillions, are frequently hard to carry out, particularly when certain entitlement programs, like Social Security and Medicare, are eliminated. Alden emphasizes that a lot of political leaders' pledges are more about indicating advantages than they are about resolving the associated expenses. She thinks that in order to make real headway on reducing the deficit, these long-standing programs would need to undergo considerable modifications, but this is extremely difficult because of both economic and political obstacles. Alden also discusses how government acts can affect Bitcoin and gold. She cautions against making investing decisions based on such speculative headlines, even though some people believe that the United States may boost its Bitcoin holdings. Rather, she advises concentrating on more general macroeconomic patterns and the changing use of Bitcoin as a financial instrument. She also notes that the market for Bitcoin and gold is so big that any action by the U.S. government, such as purchasing Bitcoin or selling gold, would be more of a publicity stunt than a significant event that would change the market. We wish to reaffirm Alden's advice to exercise patience and care. Understanding how macroeconomic patterns develop over time should be the main goal. The main lesson is that making wise investing decisions requires an awareness of market behavior and broader economic factors, not getting sucked into the noise of government promises or speculative headlines. And as always, happy investing.